I'm good, thanks. I hope you heard our conversation, mine with Joe Terranova a short time ago, where he suggested that the market is in a better place. We are in a better place, is what he said. I said you were going to take issue with that. Is that true?
Yeah, look, I think, some businesses are in a better place because they've taken the medicine and they're set up for, tougher times. As Joe rightly pointed out, good CEOs are acknowledging that. That's what they should be doing. However, those tougher times we think are going to get a lot tougher. And what we're talking about specifically is margin and profitability. So we're seeing it in the numbers. I mean, this has been our call, as you know, for the last 9 months. So I would say 9 months ago, that call was up for question. It's unequivocal now, Scott. I mean, you talk about it on your program all day. I mean, the operating leverage is going in the wrong direction. I mean, Texas Instruments is another good example where the operating profit, missed on a margin basis and also on a dollar basis. And we're seeing that all across the economy today with, Union Pacific specifically cited that. They talked about operational inefficiency. It's a theme we've had all year. And we think that theme is only about halfway baked. And it's all wrapped around this idea around inflation, which is confusing, right? We haven't had inflation like this in, any of our careers, really. And so what's happening is inflation now is coming down, but costs are sticky. And it's the opposite of what we saw in 2021. And we just think that people are underestimating the magnitude of this negative operating leverage cycle, which is made worse by inflation coming down faster than expected.
Hasn't the market already adjusted, though, to all that you just suggest is still to hit it? I mean, we absorbed a pretty good body blow on the fact of what the Fed was embarking on and the impact that all of that hiking would have.
Yeah, look, I mean, I think the market has absolutely digested the Fed. And we talked about that back in October. That's why we went tactically bullish, as you know, when we were trading at 3,500 and we were trading at 15 times earnings. We felt like that was actually a decent pitch. It worked. Liquidity was better at that point, too. But now we're at 17.6 times earnings again, Scott. And now the numbers are actually going to finally come down in a way that we didn't think would happen in Q4, which it didn't. But now we think that's happening. So we would argue against what Joe is saying. We think the market's in a worse shape because the equity risk premium is lower today, which means the market's not worried about risk. It's still focused on the Fed, which it should be because the Fed's not going to be cutting rates anytime soon. But remember, rates are lower. We already had the multiple expansion from that. So unless you think rates are going to drop here precipitously because we don't have a recession, that seems unlikely, then it's hard to argue for higher multiples to offset any earnings degradation.
Would you admit that the economy is stronger at this point in the hiking cycle than you thought it would be?
Oh, I mean, that is actually a very good question, Scott. I mean, a year ago, as you know, we were talking about the Fed was going to have to go harder. If you had told me the Fed would be able to raise 450 basis points on their way to 500, and we wouldn't already be seeing, labor cycle, a more dramatic labor cycle, a hard landing, I'd be surprised. So yes, I have been surprised at the resilience, but that just speaks to the incredible savings that was built up. The stimulus has lasted longer than perhaps we thought it could. But the Fed has recognized that, right? And so they've gone harder and they've gone higher than anybody expected over a year ago. And that's going to have lasting impact into 2023.
But doesn't it speak also to the great place that we were in, and the size of the cushion is a lot bigger than you and others suggested it might be?
Yeah, but that's played out now, right? So now the earnings are going to start to roll over because that we believe that the consumer now is going to show signs of weakening, which we did. We saw retail sales softer in December. We saw the services indices, the key ones that we focus on, that are suggesting the consumer is starting to fade, not a collapse, but not spending at those rates that they have been, which have been keeping the economy stronger than what I would have guessed.
The other idea is that the Fed is going to awaken to everything that you are suggesting, and that's going to cause them not only to pause, but perhaps to pivot. And there are hopes being, hinged on that's going to turn the cycle back positive.
Yeah, so we acknowledge that. I mean, we probably were early to suggest that the Fed would do 25 in this next meeting next week and then pause. That's been our house call for a while. And it's one of the reasons we got more constructive in October, because we said the market's going to price that, rates are going to come down. But now we've done that, Scott. So you don't get that trade twice. Now, if you told me that you thought the market believed that the Fed was going to cut rates 50, maybe 100 basis points, sooner rather than later, that's not in the market. And I would agree with you that that would potentially cause the market to go higher, or at least be able to offset the earnings degradation that we see. But we just don't see that in the cards. This Fed has been very adamant they plan to go at least another 25, maybe a little bit more, and then hold it. And I don't see why we're going to, try to second guess that right now. This Fed has a job to do. Maybe they were late to start, but they're on it now, and they're going to finish the job.
Do you feel like China reopening is a net positive for the global economy, or does it bring even more inflationary concerns that you might have?
Yeah, I mean, that's a tough kind of, sort of juxtaposition that we're in, right? Is that you're kind of rooting for China to recover from a growth standpoint, but then you worry that maybe that has a negative impact on inflation, meaning commodity prices in particular shoot up, and then the Fed can't really even pause. We're kind of more in the camp of this stimulus that we're talking about in China is going to be more consumption driven, probably more services driven. There might be a little bit of pickup in travel, which could lead to some extra energy consumption. But I don't think it's going to create an inflationary problem. I think the big surprise, not a big surprise, but I think the surprise could be that the recovery that we're going to see in China is real. I think the zero COVID policy is here to stay. That's a really good thing. And they're going to be able to reopen. But the progress is going to be slow in terms of consumption because the consumer and the consumer confidence in that region has been pretty shattered over the last couple of years. So it's going to be slow. And we don't think that that's going to be able to offset, the earnings recession that we see.
I just feel like, the more positive case is adding a few more elements to it that may not have existed, whether it's and Microsoft tells us, I know it's tougher, and Satya Nadella has warned of that, but enterprise across the board is actually holding up pretty well. And, sure, you can cite retail sales were disappointing, but there are many in the consumer-facing business, perspective who would suggest that the consumer is holding up well also. And then I would say, yeah, and the dollar's weakening too. All things that, we may not have thought were going to be the case to this point.
Absolutely. So I'd say the three big positives, or maybe there's four, would be the China reopening, which is for real. Number two, the really surprising fall in gas prices in Europe, which, partly is due to weather, but, a nice tailwind. And that's been helpful to keep, Europe from going into a worse situation for sure. And the weaker dollar, it's a relevant one. The problem with the dollar is it usually works with a pretty good lag. So it's still a headwind today, given where the dollar was a year ago. That's the way it tends to work. I think it's going to be part of the recovery story. And that's going to be, why 2024 could end up being a much better earnings story than what people are projecting even today, and where we're probably, out of consensus on the bullish side. One thing I'll give you, Scott, is, we've been in a bear market now for quite a while, right? We've had a lot of price damage. Everybody's sort of aware of what's going on. Everybody sort of has the same rhetoric, and now we're just trying to figure out, is the pitch fat enough to really put a lot of capital at risk? We would argue no, given some of the metrics I said earlier. However, if we don't get a more meaningful drawdown in the next 3 or 4 months, meaning by April, we will probably back off our call and and kind of throw it as basically saying we're not going to get that fat pitch, and that's all we're going to get, because we're still in the world of somewhat of financial repression. And that, bonds are not a great alternative necessarily longer term, and stocks are kind of the only game in town in a higher inflationary environment. We're not willing to make that call today because we think the risk reward is out of whack, unlike it was, back in October.
I hope we speak several times over the next 3 to 4 months, and we'll see what happens. Mike, I always appreciate the time, and a good day to have you on. We'll see you soon. That's Morgan.